Hi, Larry Gaines, PowerCycleTrading.com. In this video, I want to go over why selling options is considered a high winning probability type trade setup. So theoretically, I want to show you the theory behind this. You may have heard these trades called high probability or probability trades. So it comes down to what we call the option delta and trade probability. So the option delta tells us a couple things. Tells us first, it will tell us how the value of an option based on the underlying move, that value of it based on a dollar move up or down. So it'll tell you what that option value would be. Now, the other way you can use it, and this is a great way to use it that we use for really fast assessing a trade's probability for moving up or down, is we can use it to measure the probability of a price move of the underlying security you're trading or stock. So this is a really great way to quickly evaluate a potential price or strike price of an option. So when we look at this and we break down the option delta, what it tells us, it number one will measure the sensitivity of an option's theoretical value to the change in price of your underlying security. So option delta is shown as a value between minus 100 and plus 100 to show the total dollar sensitivity of the value on one option contract, which is equivalent to you controlling 100 shares of the underlying security. So normally this represents a number between minus 1 and plus 1 is how it's usually shown to you on your option platform, and it indicates how much the value of your option should change when the price of your underlying stock rises up or down by $1. So for example, if let's say you had a June 60 put and it showed you that it had a delta of minus 0.452, so you would then look at that and that would tell you theoretically that you're going to lose $45.25 if the stock price goes up by $1. So that's one way it's used to kind of show the sensitivity and the value of an option. Now it can also be used or seen as the delta of 100 shares of stock. So again, one option contract is equivalent to you controlling 100 shares of stock. So let's say you owned a June 90 call and it was showing that it had a delta of plus 0.60 or 60 cents. So your option then can be looked at as you owning 60 shares of the stock. So if you look at that delta plus 60 times 100, then that says you're controlling 60 shares. So that's the other way you can use delta. So these are really helpful tools. So let's take a look at the third way. So the third way is to use it to measure the probability of an option being in the money or at the money at its expiration. So for example, if you were to buy an option and it showed you it had a delta of 10, then the other way to look at that is that that option strike that you bought based on days to expiration only has a 10% chance or probability of being in the money or at the money at expiration. Or if you're buying an option delta with a 70 delta, you could look at that as it's giving you a 70% chance of being in the money or at the money at expiration. So this is a big reason why professional market makers or professional traders tend to a lot of times look to sell options due to these high theoretical probabilities of the option expiring worthless when you're way out of the money. So here's a quick kind of look at an option analytics on Thinkorswim. So you can see here's like Google and it was trading at $582.45. Now it's got here 22 days to expiration. The implied volatility is 29.29%. So it's saying that it could go up right here. You see that number plus or minus 34. So it could go up $34 or down $34 over the course of the next 22 days. So that's a theoretical price movement up and down. Now, if you look at this arrow here, you'll see that it says delta right there, and it shows you this delta of 0.18. So that's equivalent to like a 1 standard deviation outside point of that movement based on a standard deviation. So this price slice is what you put into your analytics, and you see this number here plus 1, that's standard deviation. So a 1 standard deviation move based on this input 22 days expiration, implied volatility 29.29, trading at 582 would theoretically be up to $622.28, or 1 standard deviation down 542.80. So that's why we can use that delta to represent that, so we don't have to kind of look every time at your analytics. So really helpful tool there. So in summary, why sell options? Well, statistically, theoretically, 68.2% or higher of all out of the money options bought will expire worthless. So then theoretically, by selling out of the money options, one standard deviation out of the money, you're going to start out with a 84% chance of winning based on these statistics. So again, if you took 100 delta minus the 16 delta, so right here, this outside point at 520, so that's going to give you 84% theoretical chance of winning. So basically what that says is that if you were to sell this 520 short strike here short, then below that, 520 and below, you've got an 84% probability price will close 84% of the time theoretically below 520 based on this trade trading at $500, X number of days to expiration, and the implied volatility. So I hope this helps, and just kind of a little bit of a training example of delta and how to use it to incorporate or help your trading. Now, based on this, you can see that the math of probability, you can see that approximately with 70% of out of the money options bought and expiring worthless, then it's probably a good idea for you as a trader to not only look at the buy side, but also look at the sell side. So good luck trading, and make sure to join us at powercycletrading.com.